up, we've got Amplitude Energy. We've got Jane Norman, the MD, and it looks like Chad Wilson, the COO as well. Good morning to you both. Obviously, as I touched on in the introduction, Amplitude's executing on one of the largest potential new sources of supply to the East Coast domestic gas market with their East Coast Supply project. So we wish you all the best with that, Jane, and it'll be great to hear a bit more about that campaign today.
Great. Thanks very much. Thanks, Declan.
Thanks. And just again, just like to remind you all, we've got the Q&A box at the bottom. If you've got any questions, we'll get to those after Jane has finished her presentation. So over to you, Jane.
Great. Thanks a lot, Declan, and thanks very much to Euroz for hosting this event. I'm here today with Chad Wilson, our Chief Operating Officer, and Chad's going to speak to some of the subsurface aspects of this program. But if I just start briefly with who we are and what this program is going to do for the business on exploration success. So we are an East Coast gas provider. Our assets are in Victoria, in federal waters in Victoria, but tied into onshore plants, Orbost plant in the Gippsland Basin, about 5-6 hours to the east of Melbourne, and then the Athena plant to the west of Melbourne, about 3 hours near the start of the Great Ocean Road. And all of our offshore infrastructure is subsea. There's no platforms, no helicopters. It's all relatively simple and ties back to the onshore plant. All of our gas goes into the domestic market. Last year, average production was 73 terajoules a day across both plants. The plant in the Otway Basin, the Athena plant, has capacity of 150 terajoules a day. And that's why we're targeting a growth project, because we want to take advantage of all of that installed infrastructure. And on success, the project will deliver around 110 terajoules a day of production across the group. We are now 50% joint venture partner with OG Energy, who bought the Mitsui stake earlier this year, and that deal has just completed. So they're our new joint venture partner. They're 50% across all the acreage in the East Coast Supply project, but we have also equalized ownership of all the acreage in the basin so that we're fully aligned with them on the economics. The project's going to be funded from the existing senior debt facility, which is a reserves-based loan facility, as well as organic cash generation. That spend is profiled across around 3 calendar years. With the improvement in Orbost and the cash generation from the Orbost gas plant and a greater proportion of that gas going into the spot market, we've seen really strong underlying EBITDAX growth in the last year. So last financial year, FY25, we're sitting around 174 million. And that gives us a lot of confidence going into this program that we're well funded from both the loan and organic cash. If we just look at the history in the Otway Basin, and obviously Risk have touched on some of these themes, but starting on that left-hand chart, you can see the basin really was opened with the Minerva project, and that produced into what is now the Athena gas plant for many years. And then we saw the first wave of exploration in the basin with Woodside and Santos as the operators at that stage, and then Origin coming in later. And that's the Casino, Henry and Netherby fields that are still in production today back into the Athena plant. And also the assets operated by Beach and owned by OG Energy in Geograph, Thylacine, and so on. And now what we're seeing is, following very strong production from those assets for around 20 years, we're now entering the second wave of exploration, with Conoco coming into 3D's acreage, Kanook more recently, OG coming in, taking the Mitsui stake. So we're really setting up for that second wave of exploration in the basin. And looking at the chart on the right, you can see where that infrastructure sits relative to the existing offshore pipelines and the onshore plants. All of the assets we're targeting are sitting close to that pipeline, and they're very much aligned to the sort of reservoirs we see in production today from Casino, Henry, and Netherby. And Chad's going to go into that in a bit more detail now.
Yeah, thanks, Jane. And I should say thanks to Adam for explaining why we have such confidence in our drilling prospects. As was mentioned, we have amplitude bright spots, as you can see on the map there in bright red. Those are the direct hydrocarbon indicators that Adam talked about, and it's overlaying the structures, the targeted structures that we have The seismic interpretation was from a data merge of the 7 historical surveys that were completed in the region and reprocessed using the newest techniques. The prospects are expected to be on the same migration pathway as the current wells in our CHN fields, meaning that we expect the gas composition to be very similar to our existing CHN wells. From the chart on the top right, you can see the prospective size of the resource and the PGs that we've assigned to each target. The Eleanor and Isabella prospects are the largest potential resource booking at more than 300 billion cubic feet of gas, and Juliet's our highest PG at 84%. In the simplest sense, the main element that influences the PG in our fields is seal. So Adam showed the formula there on what you look at for each one of the things. And for us, the main thing is seal. That gets you down to that Juliet kind of Nestor range. And then the next modifier on the PG is the effectiveness of the reservoir, which he also talked about. An example of this is the Warri C has shown to be very productive in all the wells throughout the Otway, whereas the Warri C has shown to be productive or the Warri A, sorry, has been shown to be productive in most of the wells, but we have some compartmentalization in some fields such as Henry. So it's still a really good reservoir, just not as effective as we've seen in the Warri C. So the PG is modified to account for the chance of the reservoir being a Warri A rather than a Warri C reservoir. As we further prove gas in these fields, what it does is it reduces the risk associated with the other fields listed on the chart there, fields such as Hera, Pectin East, and Nestor, and future additional development of the Eleanor and Isabella fields. So those could all be the next tranches of development for us, which significantly prolongs the life of the producing asset well into the future, which we'll show on the next slide. So the drilling program we've talked about lots in the past is the Eleanor well with a sidetrack to Isabella, as well as the Juliet and Annie wells. That project we've talked about could deliver more than 350 BCF of mean unrisked resource potential. It has a 98% chance of at least one discovery between Eleanor, Isabella, and Juliet. It also develops the 65 petajoules of 2C at the Annie field. A key advantage to our chosen program is that Juliet, Eleanor, and Isabella are all in production license. And these production leases application for Annie has been submitted. But what that all does is it means that the approval timelines are shorter, and it allows us to bring that gas on by 2028. The development that we're focused on has a minimal emissions footprint and a reduced capital outlay due to the brownfield nature of the project. It utilizes the nearby Athena gas plant, but it also utilizes all the existing brownfield infrastructure, which includes inline Ts on which can be seen on the map in a couple of those little yellow boxes or black dots on the pipeline. And we have to thank Santos for the foresight on that in developing this historic field, because those future tie-in points were all installed, and the capacity in the flow line umbilical were all thought of ahead of time to help simplify the scope and reduce the risks of our future development. On the map, you can see the existing pipelines are in red, the umbilicals in blue, the new flow lines are in yellow, and the dash blue is the new umbilical. Eleanor and Isabella are about 6 kilometers away from the selected tie-in point near the casino field, which makes the development relatively straightforward for us. We're including a 4-slot manifold, diverless manifold, and an umbilical termination assembly in the field, which is shown by that blue and yellow squares to keep that future development as simple as possible. Juliet is right next to the pipeline, you can see on the map. It's also right beside an existing inline T. So there we'll also install a 4-slot manifold and an umbilical termination assembly, which will be connected back to the casino termination point that's existing today. And Annie will be tied back into this new manifold and this new umbilical termination assembly, which is only about 10 kilometers in distance. So both are very simple, straightforward tie-ins. Like I mentioned, all the existing connections are there, so it makes it very simple. No hot tapping, just connecting the flow lines and umbilicals. So as of today, we believe that we'll be getting the rig by somewhere around the end of December, beginning of January. And we're really looking forward to moving on with this. And back to Jane.
Okay, thanks, Chad. So just looking at the CapEx for the program and how that's phased, the drilling and completions phase 1 CapEx runs over effectively calendar year 25 and 26. As Chad said, the first well is expected to start late this year, early next year, and that's going to be the Eleonora well with a sidetrack to the Isabella reservoir, which is an adjacent field. And then in the second half of calendar year 26, we'll drill our 2 option slots, which are Juliet and then back to the Annie discovered contingent resource. And you can see from the CapEx that the spend is pretty lumpy and it's dominated by the drilling spend. The other thing to remember is that the completions work is taking place as part of this drilling program. And so under our exploration EP, we have the ability to suspend an exploration well with a tree rather than a cement plug. And that's really a very capital efficient step in making sure we can tie in the wells to the existing offshore pipeline using flow lines and umbilicals as quickly as possible. And it's capital efficient, saving around 40 million per well, compared with drilling the well, suspending it with cement and coming back later to complete it in a different rig slot. So we are looking to make the program not only as capital efficient as possible, but as fast to market. We have invested in long lead items in order to do those completions and run the trees. And we're also looking to invest in flow lines and umbilicals so we can time the installation in the summer weather rather than getting pushed into the winter weather. So it's all about capital efficiency. It's all around speed to market for the gas and utilizing as much of the installed infrastructure. In terms of the CapEx guidance, we provided details in our March update to the market when we announced OG were coming in as our joint venture partner. So nothing has changed since then. In terms of what it does for the group, this project on exploration success will significantly change the group's production up to 36 petajoules a year or over 110 terajoules a day across the group. Significantly increased reserves and resources, obviously extends the life of the Athena plant. And between the 2P and 2C bookings we're anticipating, we have over 10 years of production here at around a 90 terajoule a day plateau or up to 90. There's very fast deleveraging of the balance sheet when this project comes online, and it significantly adds to the earnings of the group. This is a very high margin project. The OPEX at the plant is around $1 a gigajoule, assuming we have success and we get up to that sort of level of around 90 terajoules a day. So significant improvement in the overall business performance. And then looking at the Otway Basin and our acreage more broadly, you can see here there's lots of other exploration prospects on this map, and we've classified them roughly into 3 groups. ECSP is effectively phase 3 of the basin and the campaign, and that's Eleonora, adjacent Isabella field, and Juliet, plus tying in Annie. And on success, we will tie in the Isabella field and Juliet in this campaign. The Eleonora field is exploration and will come back in a subsequent campaign on success and develop that field. It's probably more akin to a casino field where it's going to need a couple of horizontal wells. And we've described that as Otway phase 4, probably along with the Nestor prospect, which sits just off the pipeline to the southeast there. And then phase 5 in the basin is really picking up some of those assets you can see in light blue on the map. So Hera, Pecton East, and so on. So really good running room in the basin. And with our new joint venture partner, OG, now with 50% ownership across all of this, we're really aligned in developing these options and making sure we keep the infrastructure as full as possible well into the next decade. And then finally, to touch on the market and why this program makes sense. Martin talked about this earlier and what LNG imports could do to pricing in the southeast. And when you market gas, typically the customers look at their alternative in the market. And for a customer in the southeast, their alternatives are pipeline gas from Queensland, LNG imports, or gas supply from our project. And so that really helps set their pricing reference. And if we look at the charts on the left, the first two columns are gas contracts as reported to the ACCC. Every contract has to be reported, so this data is very accurate. And you can see how much of a shift that is from our average realized gas price in FY25, which was just under $10. So the market's really moved to that sort of $12 to $18 a gigajoule. And we've just gone out to a lot of gas customers, retailers, manufacturers, and industrials to test their appetite for foundation contracts from the ECSP project. And there's strong demand, strong interest, and pricing is in line with our expectations. And certainly the potential for LNG imports in the southeast is really helping push up price expectations, but also focus those users on securing domestic gas. And then the chart on the right-hand side comes from AEMO, and it's the latest forecast from the GSU. And you can see that existing and committed supply in the green color declining pretty fast. That's dominated by the Woodside Exxon Longford production. Our anticipated supply project, the ECSP, is sitting in that grey wedge of anticipated supply, significant gas coming down from the north. And this chart assumes that Southwest Pipeline that APA runs is expanded back to Moomba to bring gas down into the southern markets. And then even with that, there's a significant gap in the market, and that's why there's an expectation that LNG imports are going to be needed. So we have a lot of confidence the market's there, customer demand is strong, and pricing's in line with what we expected and recent deals that have been signed. So ECSP is a low risk exploration program, very quickly converted into production. It's high value, high margin gas going through existing infrastructure. And the best project you can do in oil and gas is tying back new resources to existing infrastructure. So this is as brownfield as you can get, and hence we're really confident in the economics. I'll hand back to you, Declan.
Thanks very much, Jane, for that run through. A really exciting project you have there. You've previously indicated that obviously the nameplate capacity at Athena's 150 TJs, and this ECSP is looking at filling that to maybe 70 to 90 TJs. Is there an upside case that it could be producing more on an average rate, or is that really what the wells are designed for?
Yeah, potentially. We're going to choke the wells back to create that plateau because that's the shape that the customers want in foundation contracts, but the plant can obviously do more. We'll contract around 60 to 70% of the gas into foundation contracts, and that means we have the ability to put that uncontracted gas into the market. So ramp the plant up for peak price periods, or potentially if we're supplying into a gas power station on the days that they need that peak supply to run the power station. So it gives us a lot of optionality. And obviously, filling up that ullage has to be the absolute focus, and getting as much gas to market at the right price is our absolute focus in this project.
Excellent. Just a reminder, we do have the Q&A box at the bottom there. I can see one's come through from Jenny Wong at APAC Resources. She's asked, thoughts on risk on timing of drilling, how to manage if drilling pushed into winter weather?
Yeah, currently we don't expect that with our first well. So it's right now we're lining up to be in probably the best weather window of the year. So the summer drilling. On the other two wells towards the back of the program, what we've seen through the program so far is that once the rig is connected to the mooring, that the execution is actually very good, probably a little bit better than expected. So it's really that waiting on weather to connect, and then once you're connected, it's go forward as planned. Within our cost estimates, we've actually built in various weather scenarios, and included that in our planning for the cost to make sure that we've covered those scenarios off in case we do get pushed into the winter months for our other 2 wells.
Yeah, it is a good point. I mean, I know Eleanor was supposed to be part of the original Annie campaign in 2019. Is the Transocean Equinox different? Is their mooring system different? Has there been lessons learnt from the issues experienced there in the past?
Yeah, so the Transocean Equinox is a harsh weather rig, came out of the North Sea, but the mooring is a lot more detailed. I think in the Annie program there was 4 mooring lines, something like that, and in this there's about 10 to 12 mooring lines. So it's a totally different mooring design, and part of that was implementing the lessons learned from our program, from Beach's past programs, and making sure that we have the best setup to execute the program.
Great. And just on well costs, Chad or Jane, Beach has come out with guidance at 67 to 75 mil per well for their exploration well at Hercules. Obviously, your drilling and completions part of the program is 50 to 100% more than that per well. Can you just run through the cost for a development well and why they are higher than an exploration well? What different components are adding to that cost there?
Yeah, do you want me to take that? Yeah, so mostly it's the completions. So it's running the completions, running the tree, and the rig time associated with running both of those. So yeah, if you think about it as just drilling a simple P&A well, you're getting down as quick and slim as you can. But in a development type well that we're wanting to leave suspended for future production, we need to do more reservoir testing, or we want to do more reservoir testing, plus it's the time taken to run the completions and the tree.
Excellent. Thanks, Chad. We do have a few more minutes. If there's any more questions through, just type in the bottom in the Q&A box. Maybe just the last one from myself. You do touch on minor plant modifications at Athena as part of the program. Can you just run through what those are?
Yeah, so as the Athena gas plant is produced and the production has declined over time, the one piece of equipment that's there that we needed to modify over time was the gas-to-gas exchanger. So you actually have to keep your flow through the exchanger turbulent to get the heat exchange that you need for dew pointing the gas. As we've produced and the flow rates dropped off, the simple way to keep your turbulence up is to plug the tubes. So what we need to do is the main element of the gas plant work is just to replace that gas-to-gas exchanger with a new one. And then there's just some simple other relifing elements to the facility that I would consider it as normal part of integrity management through the plant. So very minor work required. And yeah, it's about relifing the plant for the next 10 to 20 years.
Excellent.
I think the other comment that's worth making about the plant is today we're using a lot of inlet compression to help the recovery factor on the Casino Henry Netherby wells. This new gas is going to be higher pressure, so we'll be able to turn that off. So the plant operating costs will drop to around $1 a gigajoule, and the emissions from the plant will be much lower because we'll be using a lot less fuel gas. So it has a big impact on overall plant performance with the new wells tying in. The plan is to suspend the Casino Henry Netherby wells, and then when the new flow reaches that same lower pressure, we'll flow them back into the system and capture that tail gas. So no immediate plans for decommissioning of any of those wells.
Excellent.
The higher the flow rate, the easier it is to operate the plant, which means it's a lot simpler facility to run.
Mm-hmm. Yeah, at $1 a gigajoule, you think you'd have some industry-leading EBITDA margins there. There was no more questions come through, but I might just touch on, Jane, you did speak through the opportunity for third-party tolling. Just conceptually, how would that look? Would that be tying in with a completely new pipeline from a third party, or is there opportunity to tie into existing pipelines? Could you just run through how that might look?
Yeah, sure. So the offshore pipeline has T-pieces in it already, as Chad mentioned, and we're putting in new manifolds. So potentially a third party such as 3D and Conoco could tie in there if they were successful and flow it in to the existing plant system. It largely depends on the composition of that third party gas, whether it needs CO2 removal and what liquids it has and whether the plant can handle that. Installing those things on the plant would be relatively simple, and an amine system has already been costed up in the event that we needed that. And we have been very public that we're open to tolling, and we're happy to have third party gas through our system.
Excellent. Well, really appreciate your time today. It looks like a really exciting project, and we wish you all the best for success in the upcoming wells later this year. So thanks for your time again, Jane and Chad.